Good evening and welcome. I'm Paul Kaufman, Dean of the Faculty of Business and Economics. First, I'd like to acknowledge the Wurundjeri, Boiwurrung and Boonwurrung people of the Kulin Nation, traditional owners of the land on which tonight's lecture is taking place. I pay my respects to their elders, past, present and emerging. I extend that respect to all Aboriginal and Torres Strait Islander people joining us here tonight. It is my pleasure to welcome you all to the 2023 David Finch Public Lecture. It's been 3 years since we've had the lecture in person, and the faculty is excited to finally have the opportunity to connect with you all again. I would like to acknowledge the members of our advisory board, senior members of the faculty and university, alumni and friends, and I'd like to especially welcome members of the David Finch family who are with us this evening. David Finch was a University of Melbourne alumnus. He graduated with joint honours degrees in Commerce and Arts in 1944. In 1948, he completed a PhD at the London School of Economics. After a short time at the University of Tasmania, David was appointed to the newly established International Monetary Fund, where he spent the rest of his working life. By the time he resigned in 1987, he was councillor and also director of the Exchange and Trade section of the organization. In 1997, the faculty received a generous donation to endow a fund to honor David Finch by hosting a significant public lecture in his name with a focus on issues pertaining to international monetary, financial, fiscal, and trade integration and cooperation. His achievements were recognized by the University of Melbourne in 2000, 2 years before his death, with the award of an honorary Doctor of Commerce. The faculty is delighted to continue honoring David's achievements through this public lecture series, and tonight marks the 25th David Finch Public Lecture. We are proud that over the years, the Finch Lecture has been delivered by global leading economics and finance experts from academia, government, and international agencies. Tonight, this tradition of excellence continues. It is therefore my pleasure and privilege to introduce our guest speaker for this evening, Professor Maurice Obstfeld. Maurice Obstfeld is a professor of economics at the University of California, Berkeley, and a senior non-resident fellow at the Peterson Institute for International Economics. Maurice received his PhD from MIT, following degrees from the University of Pennsylvania and the University of Cambridge. He is a leading expert in international economics and well known for his research on the global economy. During 2014 and 2015, he was a member of President Obama's Council of Economic Advisors and served as economic counselor and director of research at the International Monetary Fund from 2015 through 2018. Before that, he served as an honorary advisor to the Bank of Japan's Institute of Monetary and Economic Studies. Prior to joining the economics department at Berkeley, he held faculty appointments at Columbia and the University of Pennsylvania, as well as a visiting appointment at Harvard. Professor Obstfeld is a fellow of the Econometric Society and the American Academy of Arts and Sciences. He is a research associate of the National Bureau of Economic Research and a distinguished fellow of the Center for Economic Policy Research. Tonight's presentation is being recorded, and the recording will be available on our faculty website. Following the presentation, there will be an opportunity for audience questions, which will be moderated by Professor Chris Edmond. Professor Obstfeld, we are truly honored you have given us your time tonight, and I'm now delighted to hand over to you. Please welcome Maurice Obstfeld.
Thank you for that kind introduction, Paul. It's a great pleasure to be here in person in Melbourne to give this lecture. I'm following in the footsteps of many distinguished lecturers, so I hope I can live up to the standards that have been set. Last month marked the 50th anniversary of the current floating exchange rate regime in which we still live. I would like to accomplish 5 goals in this lecture. So I want to give you a roadmap. First of all, I would like to talk about the US and its position in the Bretton Woods system. This is the system that existed from the end of World War II, essentially, until 1973, centered on the International Monetary Fund. 1973 is a key year not only because of the demise of the Bretton Woods system of fixed exchange rates, but in fact, we can find there many seeds of the modern economy in which we live and the struggles we have today, the challenges we face. So I'll review some of those. I think it's also going to be appropriate to talk a little bit about David Finch and the role of the IMF. One of the preoccupations he had when he left the IMF was what its position would be in this new world of floating exchange rates. Then I'll move on to some more recent topics, more related to current research. The dollar remains the monetary hegemon of the current world economy, something that would have surprised people probably in 1973. So I'll describe the ways in which it's very, very central to not only the institutional structure of markets, but also to macroeconomic outcomes. And finally, I'll talk about the battle against inflation today and how the dollar is figuring in that battle. So that's an ambitious agenda. I don't want to keep you here all night, and I'll proceed fairly quickly through these topics. But again, we'll have some Q&A at the end for anything that isn't clear or that has sparked your curiosity. There are many people in the room from my generation for whom some of this history is not ancient, but there are also a lot of young people here. So I think it's appropriate to talk about the founding of the Bretton Woods system, the IMF and the World Bank. In 1944 at Bretton Woods, New Hampshire, an international conference, after hard negotiations, devised the basic articles of agreement for the IMF. You can see here a picture of John Maynard Keynes, who is one of the leading intellects behind this. He's sitting next to the USSR representative. The USSR was a party to the Bretton Woods Agreement, but ultimately did not join the IMF after the Soviet Union broke up. However, Russia joined in 1992. Under the system's rules, exchange rates were fixed to the US dollar. This is a very important feature of the system. The founders of that system believed that floating exchange rates would be very disruptive, as they had been during the interwar period, that they would be a drag on international trade. So fixed exchange rates were the rule. And these exchange rates were enforced through central banks intervening in the foreign exchange market, buying or selling dollars against their currencies. One role of the IMF was to provide temporary balance of payments support for countries that were trying to finance deficits without changes in their exchange rates and were running low on international reserves. Countries could revalue or devalue their currencies with IMF approval in specified circumstances. But this was a system where the US was central because the US didn't have to intervene. Its role was to fix the price of the dollar against gold. Now, how it did this was not the way that it would have happened under the classical gold standard, because for the United States, at least, US residents were prohibited from holding gold. So in effect, the US obligation boiled down to a commitment to exchange gold at a price of $35 an ounce with foreign central banks that held dollars and wished to cash them in. This was a central linchpin of the system, and at some level, it provided the nominal anchor for the overall system. Everyone fixed to the dollar fixed to gold, so gold was the anchor. It didn't work out terribly well at the end of the day, but I won't really have time to go into all the details. Why was the US so central? Well, it's the logic of the fact that if there are n currencies in the world, there are only n-1 exchange rates, and you only need n-1 of the central banks to intervene. But the US was the nth country. It did not have to intervene, and it alone had the exorbitant privilege of a fully independent monetary policy, but again, subject to this caveat of being able to trade gold with foreign central banks at this $35 an ounce price. As a result, US monetary policy was central to global inflation. The US did not have the option of devaluing the dollar either, because other countries were intervening to control their exchange rates, so they could devalue, they could revalue. The US could not. The one systemic constraint was to peg the price of gold for foreign central banks. Now, the problem, if you look at this chart, was twofold. For one thing, foreign governments wanted to hold more reserves for a number of reasons that won't detain us here. But as these reserves grew in volume, they came to equal and exceed the value at $35 an ounce of the US gold stock. More important was the fact that the US trade balance was secularly deteriorating. Now, at one level, this was a result of the success of the Bretton Woods system. It had been meant to promote post-war reconstruction. As countries in Europe, as Japan recovered, they exported more to the US. This caused disruptions in the US, not unlike those that are associated with the rise of China earlier in this millennium. The concern over gold even found its way into popular culture. So if you're familiar with this book, this movie, the basic premise was about an evil villain who wanted to seize the gold in Fort Knox and bring down the international monetary system by making it impossible for the US to meet its commitments, and of course, enriching himself in the process. Now, I want to emphasize one factor here, which is the price of these books. You could have had this one for 35 cents in 1959. 5 years later, if you wanted to see the movie with Sean Connery, 85 cents. This is a lead-in to the fact that was really central to the demise of Bretton Woods, which is that inflation in the US was rising. And there are a number of reasons for this. They're related partly to the war in Vietnam, partly to President Johnson's Great Society program, partly to his browbeating of the chair of the Federal Reserve prior to the 1968 election, which you will see as a theme in US monetary policy. But inflation was a major problem, and it was a major problem that persisted in 1969 when President Nixon came into office. Nixon had this problem. He had the balance of payments problem that I mentioned. There was quite a bit of foreign exchange market turbulence at this time. Trade competition was hurting U.S. industries. There was tremendous ill feeling toward the U.S. in many countries due to the ongoing Vietnam War. And U.S. allies were growing increasingly resentful about U.S. inflation. Students were protesting in the streets. There were racial tensions, social strife in Europe, the events in Paris in 1968, for example. And one other really key factor was a growing split between the Soviet Union and China. Against this background, Nixon had one overwhelming objective, which was to be reelected in 1972. And this drove a lot of international monetary history, as it turns out. To deal with US inflation and also the difficulties of the trade balance, the internal and the external balance problems, Nixon had a solution which was a huge political success because he was reelected in a landslide in 1972. But he essentially destroyed the Bretton Woods system single-handedly. More than likely, it would have met its demise anyway, sooner or later, but Nixon was the key figure in the events that actually brought it down. A key day is August 15th, Sunday, 1971, which some of you may remember. I actually remember it very distinctly, when Nixon unveiled a new set of domestic and foreign economic policies. He, first of all, abrogated this US commitment to peg the price of gold. You know, no more gold. If you have US reserves, dollar reserves in a foreign central bank, you just keep them, and end of the story. There were tax cuts, something Republicans continue to love, so always tax cuts. And also a wage price freeze, total anathema to conservative Republican orthodoxy, but he did it anyway. If you look at what he did, it's a very America first kind of story. He solved the gold problem at a stroke. He solved the problem of competitiveness of the US dollar by forcing US allies to revalue. He imposed a surcharge on imports, which he would only take off once US trade partners had agreed to revalue. At the time, there was also a doctrine he enunciated called the Guam Doctrine, which will sound familiar from events in the Trump administration, the idea that US allies, particularly allies in Asia, but also Middle East and elsewhere, should bear more of the cost of their own defense. Now, conveniently, to do so, they would have to buy weapons from the US, which would help the US trade balance and balance of payments. There's a great book about all of these events that came out in 2021 to commemorate the 50th anniversary of these events, which I recommend if you want to do further reading. So basically what Nixon was doing was suppressing inflation, but at a cost in the future. Inflation came down because wages and prices were frozen. The Federal Reserve was pressured to increase the rate of monetary growth in order to pump up the economy prior to the '72 election. Once the controls were removed, inflation in the US exploded to 11% in 1974. This was related to a surge in oil prices that occurred in '73 with the advent of the OPEC cartel which realized that they could actually flex their muscles and quadruple the price of oil. And inflation in the US wasn't tamed until Paul Volcker took the reins at the Fed. Of course, all of this led to the adoption of inflation targeting starting in this part of the world in the late 1980s, early 1990s. Nixon's actions didn't restore confidence in the dollar. Speculation only grew. In order to offset that speculation and to keep their currencies pegged, foreign countries had to buy dollars. And in doing so, they created their own currencies. Their money supplies grew. And in March 1973, they gave up. And you can see here the subsequent path of the US dollar. One example is the example of Germany. These are its international reserves. And you can see what happens in the early 70s to their international reserves. They go from a reasonably low level to over 20 billion very quickly. And that was real money in 1973. So the system collapsed. I'm going to skip through this slide. And I'll largely skip through this slide just to mention that one of the key legacies of this period is energy geopolitics, which of course is central to a lot of what we talk about today, the situation in Europe, the Ukraine war, the effect of sanctions, all of that is very central. And one thing that's a little ironic is that Russia actually became an energy exporter for the first time in 1973 as a result of the rise in the price of oil. And it has kept on that path ever since. Another important thing Nixon did, one reason he was so eager to get his economic announcement out in August 1971 is he was planning another announcement before the election, which he didn't want to overshadow, and that was the announcement of his trip to China. This basically changed the world, the configuration of power in the world as it was then. Of course, in 1979, years after this, with Mao dead, Deng Xiaoping put China on the path to a more market-oriented economy, and you see the result in terms of China's per capita GDP. So here we were in 1973. All is chaos. You have OPEC, you have international relations in tumult, you have high inflation spilling over from the US to the rest of the world. What would this new system look like? What was the role of the IMF in all this? Countries agreed in January 1976 to basically legalize floating through an amendment of the Articles of Agreement. It wasn't clear exactly what the role of the IMF would be. Would countries need IMF credits if they didn't need to intervene to fix their exchange rates anymore? Would countries need to hold international reserves even? Would the dollar remain central to the system? All these countries had been holding reserves in dollars and pegging to the dollar. Now that was all gone. So what was going to be the position of the dollar? And what would be the role of US macro policies? Before 1973, they were clearly a dominant force in the global economy. Everyone had to move up and down with the dollar. Was this all going to be different now? Was the world going to move to a very symmetric system? Insofar as the IMF was concerned, it turned out that the world still needed a global financial safety net more than ever, and the IMF was central to this. Early on, even a number of advanced economies came to the IMF for credit because countries still might need resources to counter sharp depreciations of their currencies. The UK in 1976 is a notorious case, and David Finch was the mission chief to the UK who negotiated the rescue package for the Labour government at that time. But Spain and Portugal, during their transitions to democracy, came to the IMF for funds. And even the US had an IMF credit line in 1978 to borrow yen and Deutschmarks to support the dollar. Hard to believe, but true. In 1982, the sovereign debt crisis that lasted for the whole decade broke out. The IMF took a leading role in helping to resolve that. The IMF developed a doctrine of conditionality to accompany its lending programs, which allowed it to, effectively force countries to carry out certain reforms, certain policies in return for credit. This, of course, had existed in some form for a long time, but it became more systematic. And as David Finch put it in a paper I'm going to talk about in a minute, conditionality is, quote, the practice of withholding access to IMF loans until the adjustment policies of the requesting country are judged to be adequate. And this actually remains very central to IMF strategy, not only with respect to countries, but with respect to countries' external creditors when debt negotiations occur. And the IMF, starting with the debt crisis in the 80s, moved much more into the business of lending and supporting emerging and developing economies. One reason for this was the explosion of global finance. The Bretton Woods system was conceived as a system with very limited private financial relationships between countries. This was supposed to be the key to countries being able to peg exchange rates without having to deal with huge speculative capital flows across their borders. But with the demise of fixed exchange rates, countries liberalized their financial markets, they liberalized international capital flows, and fund programs needed to deal with much more than just attaining a competitive exchange rate, which was the focus before 1973. Finch, in this Princeton essay that he wrote in 1989, wanted the fund to return to a focus on the larger systemic economies. He felt that the fund was in danger of marginalizing itself. He wanted the SDR, which had been created in the late 1960s as a synthetic reserve currency, to become the center of the system, which would support the IMF's role and downplay the roles of national governments. In many ways, he was trying to return to Keynes's original vision of the IMF. But none of this came to pass. Some countries, notably China, but sometimes France, talk about bringing back the SDR as a central reserve currency. That seems unlikely to happen, and we can talk about that in the Q&A. But one thing that was totally unanticipated is that all of this proliferation of international finance actually created the need for a central global currency, a kind of central numeraire for the world economy, which could also furnish a safe asset that could be used for international reserves or used for collateral in financial markets. And there was nothing out there that could really rival the dollar. So this was a big change. To give you some idea of the growth of international finance and how explosive it has been, these data show the gross external assets and gross external liabilities of emerging and advanced economies. And you can see here an astounding evolution starting around 1990 as these positions explode. They explode particularly leading up to the great financial crisis. For both groups of countries, they've grown more slowly since then, but these are still immense magnitudes. So how did the dollar reestablish itself? There was actually a period in the 70s when there was talk of actually substituting the SDR for the dollar. It came to naught, but one of the motivations was the very high inflation in the US and the resulting depreciation of the dollar, the same depreciation that led President Carter to go seek resources from the fund in 1978. But lo and behold, once Paul Volcker stabilized the dollar, this impulse passed, and the growing prominence of international financial flows reinforced dollar dominance. Perhaps paradoxically, the unprecedented budget deficits that Ronald Reagan ran as president of the US helped this by supplying copious dollar bonds that could serve as reserve assets to the markets, and other countries were happy to snap these up. The dollar appreciated wildly in the early 1980s, and now the dollar plays mutually reinforcing roles as a funding currency, a reserve currency, an anchor currency, a vehicle currency, and an invoicing currency, with no plausible substitute in sight. This chart gives you some sense of the dollar's disproportionate weight. The two lower bars show the US share of world GDP and the US share of world trade, and these are both far below the dollar's shares of anything from foreign exchange transactions to SWIFT transactions to cross-border loans. I find it useful to think about the dollar's role currently in the context of the global financial cycle. Now, I understand Ellen Ray was the Finch lecturer in 2019, so if you attended that lecture, you know all about this. But it is a tendency which she and other authors have pointed out for asset prices, commodity prices, capital flows, and leverage to move together in a cyclical fashion in the world economy. There are a number of drivers of this cycle, but one key driver is US monetary policy. And it turns out that the financial cycle is strongly correlated with the nominal exchange rate of the US dollar. When the dollar is strong, financial conditions are tight in the world economy. I think at some level you can think of the global financial cycle as actually being a global dollar cycle. Let me show you a couple of charts. I'll try to move through them quickly because time is not that abundant. This chart plots an index that Ellen Ray and colleague Sylvia Miranda Agrippino have developed of global financial activity, of the global financial cycle. It also plots the value of the dollar in blue, and you can see that when the dollar is high, when it's strong, the global financial cycle is low. At least this pattern holds closely starting in the mid-1990s when global financial integration explodes. Here's the relationship between the dollar and the growth of global trade volume. Again, a strong dollar means trade is depressed. It grows less quickly. And you can also look at the dollar and GDP growth in emerging and advanced economies, the dollar and commodity prices, Interestingly, there's an incredibly strong negative correlation between the US dollar and the Australian dollar. Now, you would expect some negative correlation, just as a matter of algebra, but given that Australia's trade share with the US is only about, well, it's somewhat under 10%, it's about 9%, this is awfully strong, these correlations. And they reflect two factors, I believe. One is the effect of the dollar on commodity prices. The other is the fact that Australia trades so much with China, and the Chinese yuan is not that variable against the US dollar. So this is pretty striking. What are the channels of dollar influence? Well, they're complicated. The US dollar is a safe haven asset, and when there's panic in global markets, people flee to the dollar, and it tends to strengthen. At the same time, a strong dollar itself may lead to tighter financial conditions by, for example, raising the real value of dollar debts, which are something that many emerging markets have, if not in their sovereign sectors, then in their corporate sectors. And if you look at dynamic analyses of the effects of movements in the dollar on emerging markets, there are a number of studies of this kind. This is one that I carried out with a student at Princeton, Haonan Zhou. But a 10% appreciation of the dollar leads to these effects in the typical emerging markets: GDP, investment, exchange rate, equity prices, and its sovereign spread, the sovereign spread on its foreign currency borrowing, which rises, indicating higher default probabilities. In the work I did with Haonan Zhou, we look at a number of drivers of the dollar against other advanced country currencies. Some of these you would expect: interest rates, short-term and long-term. We find that a measure of corporate borrowing stress, called the excess bond premium, is quite important. When there's more stress, the dollar tends to strengthen. Measures of financial frictions, and the liquidity of the dollar. So with those findings as background, I find it really useful to illustrate them by thinking about the recent trajectory of the dollar since basically the spring of 2020. And that's what this chart shows. So here the blue line is the dollar's rate against advanced economies. The brown line is its rate against emerging market economies. And you can see in March 2020 the very sharp upward spike of the dollar against all other currencies. This is the global panic effect that I mentioned. When the world economy is tanking, everyone wants to move into dollars. Monetary accommodation or monetary ease in response to the crisis, particularly by the Fed, as you can see, quickly drove the dollar down. And by the middle of 2021, roughly, it had reached a low point. Now, at that point, as I'll show you, inflation pressures were starting to emerge, and markets began to say, well, the Fed will have to tighten soon. And therefore, you see, from middle of 2021, the dollar appreciating, and it appreciates even more sharply as the Fed begins tightening, which was in March 2022, reaching a peak around last October. Last October, there was a sequence of data releases which led markets to believe that the Fed would stop raising rates and begin cutting rates sooner than expected. You can see the dollar then coming down from that peak in October 2022. And it falls until just about the first week in February, when a huge increase in hiring in the US leads markets to pivot back to the narrative of the Fed raising interest rates and the dollar pops up. Most recently, we've had the Silicon Valley Bank event and the Fed actually raising interest rates again by 25 basis points in the face of that. So I've sort of described all of these events here. I would just mention that the situation with respect to inflation was made worse with the outbreak of the Ukraine war, which happened just a couple of weeks, basically 3 weeks before the Fed started raising. And with all that going on, the RBA initiated its first hike in May of 2022. You can see the inflation events I've described here very clearly, and also the way that Australia's inflation on the right-hand side has crept up. It didn't surge in the way that US inflation did. Australia also didn't have the degree of fiscal stimulus going into the COVID recovery that the US had. But at this point, US inflation has basically dropped to where Australian inflation has risen. In the global context, Australia was not alone, of course, in raising interest rates. A wide range of advanced and emerging markets raised rates. This chart indicates the history of rate increases, decreases, and increases since 2020. 2020, basically everyone cut. Those are the blue bars. In 2021, only a few advanced economies raised their rates, but many emerging markets did. In 2022, advanced economies scrambled to catch up, which is partly behind that peak in the dollar last fall, while emerging markets continued raising rates. And the red bars show the action so far in 2023, where probably the most dramatic increase has been the recent 50 basis point increase by the European Central Bank. Here again is the picture of the dollar I showed you, and also just to remind you of the narrative that I went through on what explains these movements. Now, coming back to the global dollar cycle, it's interesting that we can actually track some of the effects that are estimated in the paper by Haonan Zhou and myself in a couple of data series. This one is data from the Institute of International Finance on capital flows to emerging markets. It's actually a daily data series that they were kind enough to lend to me for this purpose. And it tracks out these periods I talked about in terms of the dollar cycle. So you can see here in red, I'm sort of using traffic light imagery here. You know, in red, the initial COVID panic, a huge outflow from emerging markets or negative inflow. In green, next, the global financial easing and the return of capital flows into emerging markets. Sort of yellow period when the Fed has not acted yet, but markets are waiting for the Fed to act, where capital flows go in and out, but are more or less neutral. Then once the Fed starts tightening, you have net capital outflows over that period. When the hope of a soft landing emerges in the US, capital flows back to emerging markets. And then the recent period since the February, the January US jobs report with capital outflows again. So you can very clearly see that these movements in US monetary policy, which move the dollar, are also driving capital markets to go into emerging markets or to leave emerging markets in a way very consistent with Alain Ray's notion of the global financial cycle or the notion of a global dollar cycle. One indicator of financial market stresses that is very useful is the option-adjusted spread of high-yield corporate bonds over treasuries. And here you can see how it has behaved. When the spread rises, of course, corporations are finding it more difficult to issue debt, especially if they're not the most creditworthy, AAA corporations. And if you compare this chart to the chart of the dollar I showed you, the movements in this spread exactly track the movements in the dollar. And this is indicative of the sense in which financial stress in the US, which you think might depreciate the dollar, is actually transmitting to the rest of the world and leading to an increase in risk aversion, which tends to strengthen the dollar. So where are we now? What's going to happen next? And I'm going to finish with this. In the last couple of weeks, we saw a couple of bank failures in the US and intervention, very strong intervention by the US Treasury to guarantee bank deposits. We saw a failure of, or a merger of Credit Suisse with UBS. Credit Suisse is a major, globally active, systemically important financial institution, which if it had failed would have had major repercussions. So markets are a little unsettled still. And I think it's a little too early to say whether what we saw was just a mild speed bump, which will go away, or something that will come back to haunt us. If it's a speed bump, I think the Fed will hike further, and the dollar will rise some more. If this is not a temporary event, one that goes away on its own, then there are in turn two possibilities. One is that the Fed will begin to cut rates early. And if the banking problems remain confined to the US, that will probably be consistent with a falling dollar, which would actually be expansionary for emerging markets and the global economy more generally. Of course, any US recession would be negative, but a falling dollar might help. On the other hand, if the contagion moves abroad and morphs into a global crisis, that's the worst of both worlds for many reasons, but in addition, we would expect to see a strong dollar, and that could have additional negative effects abroad. So this is the sort of medium-term, as it were, distribution of possible outcomes that I see. And of course, there are other threats looming in the short term, in the medium term. Some are related to the Ukraine-Russia conflict, either directly or indirectly. For example, if China were to supply weapons to Ukraine, this would surely trigger secondary sanctions from the US and a level of fragmentation of the US economy worse, of the global economy worse than what we have seen. Longer term, there's the issue of the future of the dollar and what is that going to look like? That I'm sure you will have questions about. I'm not sure I have good answers, but I have answers that I believe anyway. But that will depend a lot on whether the US does get inflation under control. It'll depend on US political stability, which doesn't look great at the moment. It'll also depend on geopolitical tensions and global fragmentation. But I'm going to stop there and move to questions.
So we have time for some questions, and I'm just going to remind you that this is being recorded. So we have some microphones, 2 microphones, I believe. And if we'll just sort of, you can indicate that you'd like to ask a question, we'll get a microphone to you, and then we'll take it from there. So just wait till the microphone has arrived. So we've got one over here, if we can get a microphone to this lady. Oh, sorry. No.
Yeah, Maurice, you indicated that Australia trades a lot less with the U.S. than China. Given that, why does Australia tend to choose to be a sub-imperial power of the U.S.? And is this just a relic of Australia following the U.S. lead in every war since Korea?
Well, I should leave that for the Australian government to answer.
The accepted nomenclature here is we'll take that as a comment, not a question.
Okay.
No, that was a question.
Okay.
No answer.
I'm trying to think of how to put this diplomatically. You know, I don't think that economic connections are necessarily everything, and I think there is a long history of security cooperation. Now, one can question whether that's wise or not. I would argue that you know, and there's a whole issue of burden sharing of defense and things like that. But I would argue that this has traditionally been you know, for long periods, a fairly dangerous part of the world, and U.S. intervention has played an important role. We haven't had a major conflict in this part of the world for a long time, which is a good thing, but that doesn't mean that there aren't threats. So, you know, one has to balance the economic against the security aspects. You know, I think that even in terms of the pure economics, the way that Australian-Chinese interactions over trade, for example, have evolved does not give a lot of confidence in, would not give me a lot of confidence in giving up the security of a close collaboration with the United States in many ways.
Okay, so we have a few more questions. So we have one here, and one here, and one here. If we can get mics to those people.
Thanks very much for your lecture. I was interested in that graph showing the volatility of emerging markets in response to developments in the United States and financial developments. And one of the things that it led me to wonder is, you'd be familiar with Robert Schiller suggesting a range of variations on standard economic instruments, things like GDP bonds and things like that. And I wondered whether I could get you to reflect on what, if any, of those kinds of instruments might be useful for dealing with that volatility, given that it's hard to believe it's optimal. It's hard to believe that that's efficient, that all of a sudden investment charges out of the countries and then back into the countries, essentially based on international financial capacity to bear risk. That's roughly what I'm thinking.
So part of the answer is that there are increasing equity flows to emerging markets, which are much more stabilizing than debt flows. You know, there's also foreign direct investment, although some of what we call foreign direct investment is actually debt. It's sort of the way the accounting occurs. Explicit GDP-linked bonds have actually been used in some circumstances. So, for example, when Argentina restructured its debt back in the early 2000s, part of what they gave to the creditors were GDP-linked warrants as part of the settlement. So there is a precedent, but for whatever reason, and I think that Argentine experience encapsulates it. Basically, the creditors had no choice but to accept these warrants. You know, it was that or nothing. And markets just are not very happy to take these things. And part of the reason is they're difficult to design. Government statistical agencies are subject to not only inaccuracies but possibly manipulation of data. You know, in the Argentine case, it was manifest. Although, you know, I guess one argument you can make for these securities is that they might provide a. You know, most times when governments manipulate the data, it's to exaggerate their achievements in terms of GDP growth. So maybe issuing these sorts of instruments would actually discipline people like Christina Kirchner. But for some reason, you know, the market has not developed. Now maybe, you know, it's a question of critical mass and network externalities, and these would be feasible. So, you know, it's a great idea. I mean, Ken Rogoff and I wrote a text in 1996 where we actually did discuss these types of instruments and, you know, to what extent they could be welfare enhancing. So it's a great idea. The other context where I've suggested them, which I still think is a good idea, is in the context of the Eurozone, where you know, there's no central fiscal authority to, you know, sort of carry out risk sharing between countries when they're hit by idiosyncratic shocks. So if countries in the Eurozone issued linked debt, either linked to unemployment or linked to GDP, I mean, that could be really help the stability of that monetary union. But again, there's been very little interest in going that route.
Right, so we've got a question here. If we can get the mic there, and we had one down the front here, and that might be it. I think we're getting short, so Jiao.
So thank you, Maurice, for the very interesting talk. It raises many issues, one of which that I really want to hear more about is the future of the SDR. As you mentioned that SDR was emerged, but later because of the U.S. development in financial market is actually has a decreasing role. But recently, China wants to use it as opportunity to internationalize its own currency. So what do you think of the future of the SDR in particular, under what circumstances it might truly become a global currency?
Well, the basic problem is that there's no private market in SDRs. And so, you know, essentially, you know, any country can basically, you know, if they can organize their international reserves to mimic the SDR basket if they want, but no one's really doing that, and there's no private market, and they don't do it because they would really rather hold dollars or to some extent euros where there are private markets. So I just don't see the future of the SDR as a currency. It's not a currency. It's not backed by a central bank. And you know, the one time the global community moved to try to make it the central reserve asset, you know, there was no, which failed for various reasons, but there was no corresponding movement to develop private markets. Now, back decades ago, before the euro, there was a market for the so-called ECU, the European currency unit, which was basically a basket of European Union currencies. And that actually developed a little bit, but part of the reason it developed was that the markets were confident that the European currency unit was going to evolve into a real currency, which it did. And in fact, the weights in the European currency unit provided the weights at which the legacy currencies in Europe were converted into euro at the beginning of 1999. And even the market in ECU was really not very, vibrant. So, how you would actually develop a market in SDRs is it's hard for me to see when, the dollar actually works really well.
We have one last question here, waiting patiently.
The global financial crisis of 2008 was resolved with quantitative easing. The COVID crisis was continued to be resolved with quantitative easing. The now banking crisis, it seems to me that there is also an intervention by the government to resolve the problem by giving the money to the banking system. Where is all this money coming from? And what happens, it seems to me, is an inexhaustible source of funding from governments all around the world to do the same thing. How far can we go?
Well, there's no limit to a government's ability to create money. The problem is that if you do it in the wrong circumstances, you'll also create inflation. In a situation where there is a run on a bank, people would like to hold cash rather than bank deposits. The bank doesn't have enough cash, but the government lends them the cash. That's not really inflationary. So, this is the doctrine of the lender of last resort. The central bank, the monetary authority, can always lend money to stave off a bank run or a systemic bank run, and it's not an inflationary act in that context. But the answer to where's the limit, there's effectively no limit. The problem that arises, and it's a big problem, is that once the financial markets come to expect the central bank will do this in all circumstances, then the discipline of banking breaks down. And then that becomes a problem because the banking system is not going to function efficiently to allocate resources. So to me, that's the bigger threat from a regime in which there's sort of unconditional bailouts. Now, I wouldn't say that we've moved to that sort of regime because there have been attempts to also regulate banks. Clearly, they have not gone far enough and been successful enough, or we wouldn't be dealing with problems as bad as we've seen. But we have to recognize that probably the nature of banking will make it impossible to get rid of these sorts of phenomena completely. On the other hand, the circumstances of Silicon Valley Bank are such that it really should have been anticipated and regulatory action taken, which it was not.
All right, well, there may be no limits on a central bank's ability to create inside money, but there are definitely limits on the time we have available. So we've reached those limits, and it only remains for me to offer Professor Obstfeld this token of our appreciation, which I believe is a set of artisanal chocolate. The sense in which it's artisanal, I'm not clear, but I hope it is delicious. And to ask you all to join with me in thanking Professor Obstfeld in the usual way.